Hi there. For those of you who don't know me, I'm John Chang, and I lead the research and advisory services team for Marcus & Millichap, a leading commercial real estate brokerage and financing firm. To set the stage, I want to take a moment to put some things in context. Think back to where we were just 2 short years ago. The pandemic was just starting. The US was hemorrhaging jobs. In the month of April alone, more than 20 million people lost their job. Companies were scrambling to transition to remote work. Store shelves were emptying. And in-person businesses like restaurants, fitness clubs, hotels, airlines, seniors housing, movie theaters, sporting venues, and many, many more had a very bleak outlook. At the same time, the government was literally injecting trillions of dollars into the economy through stimulus checks, through the Paycheck Protection Program, through loans, housing relief, and numerous other programs. Now fast forward 1 year. In May of last year, vaccines were just starting to be distributed broadly. This was the turning point. The vast majority of white-collar jobs were working remote, and all those businesses catering to in-person interaction were still on life support. And now today, a little more than 2 years after the onset of COVID, here we are. Mask mandates have ended. People are getting back on airplanes. They're starting to go back to the office. They're going shopping and to sporting events and movie theaters and to gyms. We've replaced 95% of the jobs that were lost at the onset of the pandemic, and I expect we'll get back to pre-pandemic levels this summer. Retail sales, they're 27% higher than they were before the pandemic, and savings accounts are flush with cash. They're at an all-time high. So here's my point. In just 2 years, we went from a very bleak, uncertain future to a comparatively stable, positive outlook. But I think people always need something to worry about. If you look at the headlines today, you're bombarded with negative news. Rising inflation, the Great Resignation, the pain of rising interest rates, and how the Fed plans to contain inflation. Rising oil prices, even the prospect of a recession. But let's focus on the data and what it's telling us, starting with jobs. As I mentioned earlier, we lost a lot of jobs at the onset of the pandemic. About 22 million positions were eliminated in just 2 months. But we have since recovered 95% of those jobs and will likely finally finish backfilling that hole by this summer. But eliminating and backfilling all those jobs created a different problem, a labor shortage. Basically, over the course of the pandemic, people made some life decisions. An estimated 3.5 million people over the age of 55 left the workforce. Basically, they said, I don't need to work anymore, and I don't want to be exposed to COVID, so I'm done. 1.3 million people left the workforce to care for another person, a child or an elderly parent. I think this was exacerbated by people relocating from high-cost markets to low-cost markets, but taking their high salary with them. Bay Area tech workers, for example, who relocated to the Southwest or the Midwest, where the cost of living is much lower. Once they did the math, many determined they didn't need a 2-income household anymore, and one parent decided to stay home with the kids. A third cause of the labor shortage is tied to efforts to reduce immigration. In recent years, up until 2016, about 1.1 million people immigrated to the US each year. But by 2021, that number had fallen to about 245,000. That adds up. That's about 2.5 million less workers immigrating into the United States over the last 5 years. So as a result, we have a 5.6 million person labor shortage. That is a problem. The labor shortage has forced companies to bid for talent, and as a result, wages have increased rapidly. Wages are up 5.5% over the last year, which is almost double the normal pace. That is creating inflation. In addition, the cost of construction materials are up 15.3%, with the cost of steel notably up about 2.5 times what it was at the start of the pandemic. House prices are up by 15.2% in the last year, and that's a major inflation factor. And manufacturing inputs, the producer price index, is up 11%. I have to point out that most of these inflationary drivers tend to be long-term in nature. The producer price index is a leading indicator because it measures what companies are paying for materials. That cost increase will come back to the market as products are manufactured. And if the manufacturing materials are up by 11%, guess what that means for the price of the newly produced products? On top of all that, the war in Ukraine has pushed up the price of oil by 52.4% compared to where it was last year. That's a huge increase. It looks like we'll also see a significant rise in the price of food this summer as a byproduct of that war. And finally, there are the supply chain issues. Yes, US ports are operating better than they were 6 months ago, but that's not the root of the problem. The Port of Shanghai, which moves about 1.5 times more freight than America's two biggest ports, LA and Long Beach, combined, has been shut down since March due to COVID. In addition, shipping costs have surged from about $1,400 per container to about $14,000 per container. And on top of that, it takes about 30 more days to transit the Pacific. So the supply chain problems won't be going away anytime soon. And as a result, the underlying inflationary factors won't be going away soon. That's going to create big challenges for the Federal Reserve. So the Fed's looking at all these inflation drivers, and they boil down to a couple key measurements. Headline inflation, or CPI, is up by a bit more than 8%. And core PCE, the number most closely watched by the Federal Reserve, is just over 5%. Both of those numbers are at a 40-year high and well above the Fed's target of 2%. So the Fed has begun to pull on the one lever it has, raising interest rates. They're raising rates in two ways. First, they're raising the overnight rate. They started with a 25 basis point increase in March, then made a 50 basis point increase in May. They're telegraphing a 50 basis point increase at each of their next two meetings, one in June and one in July. Then 3 more hikes in the months after that. That will put the overnight rate somewhere in the 2.5% to 3% range by the end of the year. Increasing the overnight rate predominantly affects short-term rates. To move the long-term rates, like the 10-year Treasury, the Fed will shrink its balance sheet. During the pandemic, the Fed purchased $120 billion of treasuries and mortgage-backed securities each month. They did that to keep long-term interest rates down. As a result, the Fed's balance sheet ballooned from about $4.1 trillion before the pandemic to about $8.5 trillion currently. Now they're going to reverse that. For 3 months, they'll allow $47.5 billion of securities to mature each month and fall off their balance sheets. Then in September, they'll boost their balance sheet reduction to $95 billion per month. At that point, they'll begin selling some treasuries and mortgage-backed securities. That will push long-term rates up more. Naturally, the rate increases are creating some challenges. Home buyers are upset that mortgage rates for houses have gone up from about 3.5% to about 5.5% over the last couple months, eroding their purchasing power. Meanwhile, Wall Street has become more choppy as investors grapple with the implications of higher interest rates. But while we've all gotten used to exceptionally low interest rates over the last 10 years, we have to remember that this is far from normal. If you look back at interest rates over the longer term, going back as far as the data is readily available, the mid-1950s, it's apparent that interest rates have been abnormally low since the global financial crisis in 2008 and 2009. The 10-year is now back up to the 3% range, where it was in 2018. But that is still low by historical perspective. The long-term average for the 10-year Treasury is 5.7%. So even though the rate increases are a bit painful for some, in the big picture, we have exceptionally low interest rates right now. The economy will go through a bit of whiplash as it recalibrates to the changes, but once people get over the initial shock, things like home buying should begin to normalize. By raising the rates, the Fed is trying to tamp down consumption. Basically, they're raising the cost of borrowing money, whether that's for a mortgage or using a credit card. But there's a problem ahead. Retail sales recovered from the pandemic recession in nothing flat. The stimulus did its job, and following an initial dip, retail sales bounced back, then started to climb. That's a lot of consumption, and it has basically outstripped the recovery of manufacturing and shipping that has induced shortages and in turn inflation. But over the last 2 years, people have put a lot of money away. People have about $5.7 trillion more dollars in savings and money market accounts than they did before the pandemic. For the first time in 30 years, households have more savings than debt. And as a result, raising interest rates may have less effect on inflation than the Fed is hoping. They're raising the cost of debt, but households have an abnormal abundance of cash on hand, so they're less reliant on borrowing. That's a good thing, but it likely means that raising rates may be a slow way to curtail inflation, since it probably won't reduce consumption that much over the short term. Finally, with regard to recession risk, it's out there somewhere. In fact, the Fed may even purposely push us into a recession to get control over the inflation. But that's not the baseline forecast. Right now, most economists are predicting economic growth of 2.5% to 3.5% this year, moving down below 2% growth next year. All things considered, that's not bad. Now, I'll shift my focus to the commercial real estate market. To start, I want to focus on two macro drivers that are having a big impact on commercial real estate. The first is the pandemic. We're not completely out of the woods yet, but I think we're pretty much done with the masks, the economic shutdown, and even the social distancing. There are states that ended the lockdowns more than a year ago, and some that just recently ended their tightened health restrictions. But the ones that ended early are way ahead on their recovery. Compared to before the pandemic, the states that ended restrictions early have recovered all of the jobs they lost. In addition, retail sales in those states are up 22.7%, and their combined office vacancy rate is only up 270 basis points. By contrast, the states that ended their COVID restrictions later have more ground to make up. Their employment is 2.4% below pre-pandemic levels. Retail sales in those states are up by only 19.2%, and their combined office vacancy rate is 490 basis points higher than before the pandemic. The real estate story here is that the states that ended their restrictions more recently may yet deliver an economic and commercial real estate bounce as businesses reopen and re-engage customers. The second macro driver we need to watch is tied to demographics. The generational population cohorts and how their interaction with commercial real estate differs. There are really just two main groups to consider: the baby boomers and the millennials. They have the largest populations. Over the next 10 years, over 1 million baby boomers will turn 75 years old each year. That will drive demand for medical office and seniors housing. Right now, baby boomers represent 27% of the population, but they represent about 39% of the total healthcare visits. And that will continue to rise. People over the age of 75 use healthcare services 6.4 times per year. People between 65 and 75 use medical services 4.9 times per year. And it goes down from there with younger people. The point is, healthcare demand, both medical office and seniors housing, is about to surge as the baby boomers push up into their 60s, 70s, and 80s. The other cohort of note, the millennials, are significantly affecting numerous commercial real estate property types. There are 72 million millennials, and they are between 26 and 40 years old. The peak age of the cohort is 30 or 31 years old, which is right on top of the family formation years for this age group. The median age of marriage in the US is 30 years, and that is a key trigger point to form a new household. The median age of first-time homebuyers is 33. So there's a lot of pressure on the housing market. Yes, rising interest rates will take some of the pressure off, but at the end of the day, we have a demographic wave right on the cusp of moving out on their own. That's why I don't believe the housing market is due for a correction. There is a housing supply shortage, and it won't go away for several years. Another property type getting a boost from the millennial generation is self-storage. Millennials over-index as users of storage, with just 28% of the population renting 39% of the storage units. That bodes well for storage demand. But there are some development risks for this property type on the horizon. As we exit the lockdowns and as demographics drive property demand, the bigger picture points to generally strong drivers across the commercial real estate spectrum. Some segments like urban office and seniors housing still face some challenges, but it looks like most other segments are in a growth stage of the cycle. Hotels, suburban office, some types of retail, medical office, multifamily, self-storage, and industrial properties are all either performing well or on the upswing. I'll walk through a snapshot of the performance of each of the major investment property types, starting with apartments. Driven by the demographic forces I mentioned earlier, housing demand set an all-time high in 2021. The total unit absorption hit nearly 660,000 units. The next closest reading on record was the year 2000, when 375,000 units were absorbed. Demand carried into 2022, delivering the best first quarter on record with an additional 110,000 units filled. The record demand reflects a debundling of households as vaccines became readily available and states ended lockdowns. A lot of marriages and other household formation events had been delayed by the pandemic, and we saw the release of that pent-up demand over the last year. The end result was a record low vacancy rate of 2.4% at the end of the first quarter of 2022 and a dramatic surge in rents. On a year-over-year basis, average rents in the first quarter of 2022 were up by 17.3%, another record. Those dramatic rent increases have generated a lot of attention from rental advocacy groups and the media, but we have to put them in perspective. During the health crisis, there was an eviction moratorium. Rents were frozen in many instances, and even if rents were not officially locked in place, most owners held rents in place to help tenants weather the storm. Between the first quarter of 2020, when the pandemic started, and the first quarter of 2021, average rents went down by nearly 1%. So over the course of 2 years, from before the pandemic through the first quarter of 2022, apartment rents increased by 16.3%. That's about 8% per year. Still high, but not shockingly so. We also need to consider that during the same 2-year span, single-family home prices increased twice as fast. They went up by 34%. At the heart of the problem is a housing shortage. Even though a record 400,000 apartment units are scheduled for completion this year, we will still fall short of demand. We're forecasting vacancies will remain at 2.4% through the end of the year, and rent growth will subside to 9.4% in 2022. Next, I'll focus on self-storage because it was influenced by trends similar to housing. At the onset of the pandemic, self-storage properties pulled back on rents, but demand surged. College students left school early, putting stuff in storage. Households doubled up and people cleared rooms to create a home office. A lot of the stuff cleared out to make room for those home offices went into storage. Although there was a self-storage supply overhang going into the pandemic with a national vacancy rate at 9.5%, most of the vacant space was rapidly absorbed. That pushed vacancy rates down to 6.6% by year-end 2021, a record low. That translated to 7.6% rent growth last year. We're seeing demand ease back a bit, and construction is starting to ramp up, so vacancy rates may begin to push up again. We're forecasting vacancy rates will rise to 6.9% by the end of the year, with rent growth in the 4% range for 2022. Now I'll shift to the industrial market, which also got a strong boost from the health crisis. Like apartments and self-storage, industrial demand surged to a record level in 2021, pushing vacancy rate to a record low 3.9%. Although construction will likely set a new record in 2022 with the addition of about 420 million square feet, we expect vacancies to continue to decline. The most significant force driving industrial space demand is the snarled supply chains. Companies are facing big challenges in sourcing internationally manufactured products, particularly those produced in China. As I mentioned earlier, the country's zero COVID policy is shutting down entire cities and ports. To address the supply chain challenges, companies are boosting orders to build up domestic safety inventories. That in turn is driving up industrial space demand, particularly in major port cities and distribution hubs. One thing to watch over the next few years will be a trend toward reshoring and nearshoring of manufacturing that will shorten and streamline logistics chains. Labor costs in China have increased significantly, bypassing Mexico. So many companies are considering moving their manufacturing operations there. We're already seeing increased freight traffic coming across the southern border, and industrial space demand in cities near border crossings like San Antonio and San Diego has surged. A principal driver of industrial demand has been retail sales. As I mentioned earlier, they have been off the charts, up 27% since the onset of the pandemic. A lot of people think this is predominantly an e-commerce phenomenon. But after shooting up at the beginning of the pandemic, e-commerce sales actually flattened, and they're moving back into alignment with their original long-term trajectory. At the same time, store-based retail sales are up 19.3% from pre-pandemic levels. Think about that for a moment. A lot of people believe retail got killed by the pandemic, but in fact, most retail properties held up well. Necessity retail, like grocery-anchored centers, performed best. But in states that ended COVID restrictions early, restaurants and other service-based retail already bounced back. There's still upside retail potential in states that ended their lockdowns last, and those properties could deliver outsized results in the second half of this year and into 2023. Nationally, the multi-tenant retail vacancy rate was 5.7% before the pandemic, and in 2020, the vacancy rate increased to 6.6%. Since then, retail center vacancies have been drifting lower and stood at 6.1% in the first quarter. We expect the declines to extend through the remainder of the year, pushing the multi-tenant retail vacancy rate below 6%. The final property type I'll highlight is office. Office properties have experienced significant variance depending on the city, location, type of building, and type of tenant. Overall, vacancy rates climbed from 12.7% at the end of 2019 to a peak of 16.1% in the second quarter of 2021. Since then, overall vacancy has eased to 16%. But there are nuances. Suburban office property vacancy rates didn't rise as much as their urban counterparts. They only rose 290 basis points over the cycle to a peak of 15.8%, but have since come back down to 15.5%. Again, perceptions of office space demand tend to be worse than the reality. Although many think that working from home will be the death of the office space, we have actually seen 4 continuous quarters of positive space demand. Based on the corporate messaging I'm hearing coming out over the last few months, there will be some flexibility on where staff members work, but major companies are slowly pushing toward a substantial return to the office. It will likely take a few years for the office sector to fully recover, especially in markets that opened later than most of the others like New York and San Francisco, but the momentum is beginning to build. Now I'll shift over to commercial real estate sales trends, which is my last section. Commercial real estate transaction activity last year was record-breaking. There were about 29% more transactions in 2021 than in 2018, the previous record year. A lot of the gains were driven by the three property types that outperformed: apartments, self-storage, and industrial. But demand for hotels and retail also showed positive traction. Office investors remained more hesitant, awaiting more clarity on office space demand. The activity surge drove property prices up across the board. Compared to pricing at the end of 2019, before the pandemic, office properties had the most modest gains, just 12% on a national level. Multi-tenant retail and hotels are both up 13%. The biggest gains were made by apartment properties, up 23%, self-storage, which climbed 35%, and industrial assets that surged up by 51% from the end of 2019 through the first quarter of 2022. There was tremendous market liquidity last year. Capital was chasing yield, stability, and upside potential. The extremely favorable fundamentals outlook of apartment and industrial properties fueled bidding wars, especially in strong growth markets. Self-storage was drawing attention not only for its record-breaking vacancy and rent growth trends, but also for its demonstrated durability during recessions and its inflation resistance. Now, all commercial real estate tends to be favored as an inflation hedge investment because replacement costs and values tend to rise with inflation. Hotels, self-storage, and apartments have additional resistance because they can move rents with the market. So investors flush with cash were willing to push the envelope on pricing for the best apartments and the best industrial properties in the best markets. In some instances, apartment cap rates pushed to the mid 2% range. Some industrial properties achieved cap rates in the upper 2% range, and the top tier self-storage assets traded at 3 caps. Some of the momentum has been eroded by rapidly rising interest rates, but first quarter sales activity was still robust, well ahead of the first quarter last year. But it is still too early to determine whether the extremely liquid investment market will sustain buyer demand. Given the anticipated trajectory of interest rates, the competitive bid climate could ease in the second half. So in wrap up, I want to reiterate a few key points. First, despite the headlines, the U.S. economy is still strong and it will continue to support commercial real estate space demand. Second, inflation will likely be a multi-year headwind, forcing the Fed to steadily tighten monetary policy. Ultimately, the Fed may need to force a recession to slow inflation. Third, rising interest rates will restrain commercial real estate transaction activity, but not on a broad basis. The effects of rising interest rates will be most visible in the property types and markets that had the most aggressive pricing run-up over the last couple years. Fourth, as a perceived inflation hedge and with more reliable returns than most other investment options, commercial real estate will continue to see strong investor demand. And finally, investors should not expect a real estate bubble, not in housing and not in commercial real estate. There are too many long-term demand drivers in play for any of the sectors to face a significant correction. Thank you for sharing your time with me. I'm John Chang, and I lead research and advisory services for Marcus & Millichap, a leading commercial real estate brokerage and financing company. Please feel free to reach out to me if you have any questions.